One of the things we've seen is apparently a pulling back by the banks in making loans. What does that mean as an opportunity potential for private credit?
Sure. I mean, one of the reasons the banks are being forced to pull back right now is concerns around their own liquidity situation. Liquidity kills banks, not solvency generally. You look at the private credit market. Somebody was asking me about this the other day. What's going on with these shadow lenders? And I said this wasn't a shadow banking problem. This was a banking problem, classic asset liability mismatch problem. The private credit market, very differently, generally the participants in that market have very long-dated liabilities. So they have the ability to be consistent and thoughtful about the way they deploy capital. They're not subject to redemptions. They can be a consistent relationship lender to private equity firms. So when they see an opportunity where the markets step back, capital markets are closed, they can come in and be a provider of choice and enable private equity transactions to take place. So it's an attractive asset class, it's defensive in nature, it's floating rate in nature, and at a time like this, you can extract a particularly attractive credit and illiquidity premium.
Is there any transparency risk in private markets? That is to say, in public markets, you sort of know where the value is. Private markets, you're not quite as sure. And right now, we've seen some hidden liabilities we didn't know were out there.
Look, it's a great question, and I do think the discipline of being held to account minute by minute in the public markets is a great discipline. But there are also certain types of businesses that benefit from growing and scaling outside the without being subject to the day-to-day scorecard. Essentially, certain types of businesses that aren't profitable for a long period of time sometimes are better off being built and compounded in private market format. Look, it's a great question, but I think generally what you find is these are large, sophisticated investors managing these pools of money. And there's upsides to that as well, because you're not forced out of the trade. You can carry the trade, so you can take a long-term view of value rather than thinking what's going to happen over the next 1 week, 3 months, or 6 months.
Laurie, there's some debate about whether we should call this a banking crisis. It was a crisis for Silicon Valley banks, and not clear it's for a crisis for the banking industry overall. But it certainly was a lot of turmoil. I know that you have specifically looked back in the past at some similar crises or points of turmoil, and you actually took a look at the NASDAQ 100 during some of those. Take us through that. We have a chart to show.
Yeah, so I'm a great student of history when it comes to markets, and I think this is going to end up having its own name. It's going to be its own unique crisis, but to me this is more like WorldCom than it was like Bear or Lehman. And we took notice of the fact that the banks were trying to stabilize recently, and so we went back and essentially looked at kind of the problem industries in both that 2000-2003 period and the financial crisis. And what we found was that after both Bear and Lehman, you basically saw the banks continue to act really poorly. If you go back though to the tech bubble period, we saw that after WorldCom, NASDAQ 100 actually stabilized and kind of entered this very long, lengthy bottoming process. So it wasn't quite a clearing event. It was something close to it, but it did sort of, it was sort of cathartic in a sense that, some of these excesses were exposed and dealt with, and then the market, took some time to heal, but ultimately was able to move on.
So Laurie, help us make a little money here. As you look at the equity markets right now, where are things you think underpriced? In fact, that you might be able to find some bargains.
So, I've been hoping that industrials would get cheap in all this, and it didn't. We're neutral that sector. But one area we've been watching really closely is the small caps. Now, obviously, the banks and financials are a big drag there, but that's not the only part of small cap that's been underperforming in here. Consumer stocks have been underperforming, tech stocks, energy stocks within that small cap landscape. So we would say, if you don't want to just sort of go all in on the small cap space, generally try to look at some of those non-financial sectors to find some babies that have been thrown out with the bathwater.
Julian, the same question to you, more broadly, not just equities, but including debt, including alternatives, other possibilities. Where are there bargains right now that you're looking at?
Yeah, look, I think on the public credit side, I think investment grade credit is an attractive area to be right now. You're getting paid getting paid 5% plus nominal rates of return for owning pretty low risk credit. And, given some concerns about the softening economic environment, staying higher in quality, pushing out duration a little bit, benefiting from what's likely to be eventually a rollover in the rate curve. So I think that's one area. And then I said on the private side, it's more of the credit-like products. Private credit for corporates, private credit for real estate is where we're seeing the biggest opportunity set right now. Really quite extraordinary, especially on the real estate side. We're still seeing more limited opportunities to deploy capital on the private equity primary side, and in the growth equity side, where we're still seeing, back to this point about the discipline of the public markets. That's starting to roll through in terms of private growth equity, but that valuation reset hasn't fully happened. I think that's going to roll through, and we'll start to see great opportunities 6 and 12 months from now. But where we are seeing is on the secondary private equity side. So this is owners of private equity assets that are looking to essentially rebalance their portfolio because they've suffered the denominator effect. They found themselves longer than they would like to be because their bonds and equities went down, the non-mark-to-market private assets stayed where they were. So we're seeing interest in people investing in private equity secondaries.
Lori, if you go in the Wayback Machine all the way back to the beginning of March, 30 days ago, we were worried about inflation and what the Fed was going to have to do and would we go into a recession. Are we getting a little complacent on the question of what the Fed's going to do and the real possibility of a recession?
Well, look, I think that the word accelerant is what's really stuck in my head from the past week. And I really worried when I put my year ahead outlook out that we were going to get to September, October, and still be debating whether or not we were about to tip into a recession. I think that, when we talk about lending, for example, slowing down, we already knew that was going to happen. Did this crisis sort of accelerate that trend? Our businesses that were already starting to lay people off are going to bring that forward. It's not fun. It's not something we want to see. But frankly, from a market pricing perspective, I think you're a little bit better off having that damage contained in 2023 than 2020 bleeding in. So I don't think we're complacent, but I think, I've talked to a lot of people this past week, the question, what's changed in your view? I don't think a lot of things have really changed in people's longer term views. Maybe just the path to how we get there is a little bit different.